Most traders come to options trading looking for certainty. They want the perfect setup, the secret indicator, the guru's private strategy, the thing that finally removes doubt from the outcome. And when they don't find it, frustration sets in. Losses feel personal, wins feel temporary. Confidence swings with every trade. But profitable options trading doesn't begin with the market. It begins with how you relate to uncertainty. The uncomfortable truth that gurus rarely tell you is this: the market never offers certainty, and it never will. Profitability is not created by knowing what will happen next. It is created by being completely at peace with not knowing and still executing flawlessly. The traders who survive, grow, and eventually thrive are not smarter. They are not more intuitive. They don't predict better. They simply think differently. They operate from a mindset where outcomes no longer control their emotions, and emotions no longer control their decisions. Becoming a profitable options trader is not a mystery. It's a process, a psychological progression. And it happens in 4 steps that feel simple on the surface, but challenge everything most traders believe about money, success, and control. Profitability begins the moment you stop trying to be right, because the need to be right is not a trading skill. It is an emotional demand placed on an environment that does not respond to emotion. The market does not know who you are, what you believe, how much effort you've put in, or how badly you want a trade to work. Yet most traders enter every position carrying an invisible expectation. This trade should confirm that I see the market correctly. That expectation quietly turns trading into a personal referendum on intelligence, discipline, and self-worth. From that moment on, the trader is no longer managing risk. They are managing identity. When being right matters, every tick against your position feels like a threat. Your attention narrows, your objectivity collapses. You start watching price not as information, but as judgment. A small loss feels unacceptable not because of the money, but because it contradicts the story you're telling yourself about your ability. That is when traders hesitate to exit, rationalize poor entries, widen stops, or interfere with positions that were perfectly fine before fear entered the picture. The market didn't change, your relationship to the outcome did. The paradox is that the more you try to be right, the less capable you become of trading correctly. Correct trading is not about prediction. It is about execution within uncertainty. The market offers no guarantees, only probabilities. Any edge you have, no matter how robust, will express itself over a series of trades, not on the next one. But the mind that needs to be right cannot think in series. It fixates on the singular outcome directly in front of it. That fixation turns randomness into meaning and variance into personal failure. Professional traders understand something that struggling traders resist. A losing trade does not mean you were wrong. It only means this particular outcome occurred. There is a profound difference between being wrong and experiencing a loss. Being wrong implies a flaw in thinking. A loss is simply the cost of doing business in a probabilistic environment. When you blur that distinction, you create emotional instability. When you separate them, emotional neutrality becomes possible. The market is not a place where certainty can be achieved. It is a place where uncertainty must be accepted. The need to be right is, at its core, a refusal to accept uncertainty. It is the mind saying, I need to know. In an environment that will never allow knowing, that internal conflict produces anxiety, and anxiety produces behavior that sabotages performance. Traders then try to fix the behavior without addressing the belief that caused it. They add rules, indicators, confirmations, anything to reduce uncertainty. But no amount of information can eliminate uncertainty. It can only create the illusion of control. When you stop trying to be right, you stop fighting the nature of the market. You no longer demand that the next trade validate you. You no longer interpret losses as mistakes that must be avoided at all costs. Instead, you begin to see each trade as one of many, each outcome as a data point, not a verdict. This shift does not happen at the level of strategy, it happens at the level of belief. A trader who has stopped trying to be right enters a trade knowing, emotionally, that it may lose. Not as a disclaimer, but as a fully accepted reality. That acceptance removes fear from the equation. And when fear is gone, there is no reason to interfere. Stops are honored. Targets are respected. Trades are allowed to play out. Consistency becomes natural, not forced. Most traders believe discipline is about willpower. They think they must fight impulses, suppress fear, and control greed. But discipline that relies on effort is fragile. It breaks down under stress. True discipline emerges automatically when there is nothing to defend, when you are no longer trying to protect your ego. There is no internal argument about what to do. The rules are followed because there is no emotional incentive to break them. Trying to be right also distorts learning. When traders are focused on being right, They selectively remember information that confirms their beliefs and ignore information that challenges them. Losses are blamed on external factors, manipulation, news, bad luck, while wins are credited to skill. This prevents accurate feedback. Growth requires honest observation, and honest observation is impossible when outcomes are filtered through ego. The trader who has released the need to be right can look at a loss and ask a simple question: did I execute my plan? If the answer is yes, the trade was a success regardless of the outcome. If the answer is no, the trader adjusts behavior, not self-worth. This distinction is everything. It transforms trading from an emotional struggle into a professional process. Consistency is not about avoiding losses. Losses are inevitable. Consistency is about producing the same behavior over and over again in the presence of random outcomes. That is only possible when outcomes no longer carry emotional weight. As long as you are emotionally invested in being right, every trade has the power to destabilize you. When you let go of that investment, trades lose their power over your state of mind. The irony is that profitability often appears only after traders stop chasing it. When you stop trying to force the market to pay why, you begin to trade in alignment with how the market actually works. You stop overtrading. You stop taking marginal setups. You stop needing action to feel productive. Patience emerges because there is no urgency to prove anything. Option trading, in particular, exposes the cost of needing to be right. Defined risk strategies make losses visible and unavoidable. You cannot hide from risk. You must choose it up front. Traders who still need to be right struggle here because every loss feels premeditated and personal. Traders who have accepted uncertainty see defined risk as freedom. The worst-case outcome is known and accepted, so the trade itself becomes emotionally neutral. When you no longer need to be right, you begin to think in probabilities naturally. You understand that edges play out over time, not immediately. You understand that variance is not an enemy, it is the mechanism through which opportunity exists. Without uncertainty, there would be no edge to exploit. The same randomness that produces losses also produces profits. You cannot reject one without rejecting the other. At this stage, trading stops being dramatic. There are no emotional highs or lows. Wins do not create euphoria. Losses do not create despair. There is simply execution and review. This emotional flatness is not boredom, it is clarity. It is the mental state from which consistent performance emerges. Most traders never reach this point because letting go of being right feels like letting go of control. In reality, it is the opposite. The need to be right is what keeps traders trapped in reactive behavior. Letting go restores control where it actually exists in preparation, risk management, and execution. You cannot control outcomes, but you can control whether you behave like a professional. Profitability does not arrive as a sudden breakthrough. It arrives quietly, almost unnoticed, when your internal dialogue changes. When you no longer ask, will this trade work, but instead ask, did I follow my process? When your emotional state no longer fluctuates with P&L. When losses feel ordinary and wins feel expected over time, not demanded immediately. The market rewards those who respect uncertainty, not those who fight it. It rewards those who can execute without emotional attachment. It rewards those who understand that being wrong is not a problem thinking. You must be right is. The moment you stop trying to be right, you stop giving individual trades power over you. And when trades lose power over your emotions, your behavior stabilizes. When your behavior stabilizes, your results eventually follow. That is why profitability begins not with a strategy, not with a secret, not with a guru, but with a simple, difficult, and liberating decision to let go of the need to be right and allow probability to do its work over time. Risk acceptance is the gateway to emotional freedom because fear cannot survive in a mind that has already accepted the worst CA outcome. Most traders believe they understand risk. Yet what they actually understand is risk in theory. They know where the stop is, they know the maximum loss, they know the math. But emotionally, they are still hoping. And hope is evidence that risk has not been accepted. The moment you hope a trade works, you have already introduced fear. Hope means there is something you want to avoid feeling. It means the loss is still psychologically unacceptable. That is why price movement against your position creates tension. That is why you watch every tick. That is why you feel relief instead of neutrality when the market moves in your favor. None of that comes from the market. It comes from incomplete risk acceptance. True risk acceptance happens before the trade, not during it. It is a mental state where you fully embrace the possibility of loss and feel no need to defend yourself against it. You are not bracing for impact. You are not bargaining with the market. You are not secretly planning how to escape discomfort. You have already decided that if the worst happens, it will be fine. Not intellectually fine, emotionally fine. When risk is truly accepted, the market loses its ability to threaten you. Fear exists only when there is something at stake that you are unwilling to lose. Once you accept that loss as part of the process, fear has no function. There is nothing left to protect. And when there is nothing to protect, your mind becomes clear. Most traders confuse emotional control with emotional suppression. They try to stay calm while internally resisting the possibility of loss. This creates internal conflict. One part of the mind is executing the trade, while another part is watching for danger. That divided attention leads to hesitation, overmanagement, and inconsistent decisions. The trader feels exhausted, not because trading is hard, but because they are fighting themselves. Emotional freedom does not come from managing fear. It comes from eliminating the need for fear. Risk acceptance does exactly that. It removes the internal argument. You no longer ask, what if it goes against me? Because you already know the answer and you are already okay with it. The mind stops scanning for threats and starts focusing on execution. In options trading, this principle becomes even more critical. Defined risk strategies make the maximum loss clear from the beginning. This should be liberating. Yet many traders experience more anxiety instead of less. Why? Because seeing the risk in advance forces them to confront what they are unwilling to accept. The numbers expose the emotional resistance that was always there. Traders who have not accepted risk place trades while secretly planning to escape loss. They intend to exit early, adjust the position, or figure something out if things go wrong. That hidden escape plan keeps fear alive. The market senses nothing, but the trader's behavior becomes reactive. Decisions are made to avoid pain, not follow a plan. A trader who has accepted risk enters the position with no escape fantasies. The stop is real. The loss is real. And because it is accepted, it is no longer emotionally charged. This is what creates emotional freedom. You are no longer negotiating with the market. You are participating in it. Fear distorts perception. When risk is not accepted, the trader sees danger everywhere. Normal price fluctuations feel threatening. Small drawdowns feel catastrophic. The mind begins to interpret randomness as intention. This leads to premature exits, missed opportunities, and constant second-guessing. The trader thinks the problem is strategy, but the problem is fear-based perception. Once risk is accepted, perception stabilizes. Price movement is just movement. The market is no longer against you or with you. It is simply unfolding. This neutral perception allows you to stay present and responsive instead of reactive. You are no longer trying to predict or control. You are allowing probability to express itself. Risk acceptance also changes how you relate to money. Money stops being emotional fuel and becomes a business expense. Losses are no longer failures, they are costs. Just as a business owner accepts rent and payroll as necessary expenses, the professional trader accepts losses as part of operating in uncertain conditions. Emotional freedom comes from this reclassification. Most traders experience emotional highs and lows because they are emotionally invested in outcomes. They feel euphoria when they win and devastation when they lose. This volatility is not caused by market swings, it is caused by unaccepted risk. When you accept risk, outcomes lose their emotional charge. Wins feel satisfying, but not intoxicating. Losses feel disappointing, but not threatening. Stability replaces drama. This stability is what allows consistency to emerge. Consistency is not a function of talent. It is a function of emotional neutrality. You cannot behave consistently when fear is present because fear demands immediate relief. It pushes you to act, adjust, interfere, and override your plan. Risk acceptance removes that pressure. Another overlooked aspect of risk acceptance is responsibility. When you accept risk, you take full responsibility for the outcome of every trade. There is no blaming the market, the news, or other traders. You chose the risk, you accepted it. This ownership is empowering. It shifts you from victim to operator. Emotional freedom is impossible without responsibility. Many traders believe that accepting risk will make them careless. They fear that if losses don't hurt, they won't care. In reality, the opposite happens. When emotions are removed, attention sharpens. You care more about process, execution, and long-term performance. You stop gambling and start operating. The greatest psychological shift occurs when you realize that emotional pain in trading is optional. Losses are unavoidable, but suffering is not. Suffering comes from resistance. Resistance to uncertainty, resistance to loss, resistance to reality. Risk acceptance dissolves that resistance. What remains is clarity. As this clarity deepens, confidence begins to form, not the fragile confidence based on recent wins, but a quiet confidence rooted in self-trust. You trust yourself to execute. You trust yourself to handle losses. You trust the process over time. This confidence is stable because it does not depend on outcomes. Emotional freedom does not mean you stop caring. It means you stop attaching your identity to results. You can be fully engaged without being emotionally entangled. This is the state in which peak performance happens. Decisions are clean. Actions are deliberate. There is no rush, no panic, no hesitation. Risk acceptance also changes how you experience drawdowns. Instead of reacting emotionally, you evaluate statistically. You ask whether the drawdown is within expected parameters. You adjust size if necessary, not out of fear, but out of prudence. This rational response is only possible when fear has been removed from the equation. The market will always be uncertain. That will never change. The only thing that can change is your relationship to that uncertainty. Risk acceptance is the bridge between anxiety and professionalism. It is the moment you stop trying to avoid pain and start operating with clarity. Emotional freedom is not given by the market. It is claimed by the trader who accepts risk fully and completely. Once that acceptance is real, not theoretical, the market loses its power to disturb you. And when the market can no longer disturb you, your behavior stabilizes. That is why risk acceptance is the gateway. On one side is fear, hesitation, and inconsistency. On the other side is calm execution, discipline, and long-term profitability. The market does not decide which side you stand on, you do, every time you choose. Whether to truly accept the risk before you enter a trade. Discipline is not willpower, it is structural simplicity, because no human mind can consistently override emotion in an uncertain environment through effort alone. Traders often believe discipline as a personal trait, something you either have or don't have. Something that must be summoned in moments of pressure. They try to be strong, to resist impulses, to force themselves to follow rules, while fear, hope, and urgency pull them in opposite directions. That approach fails not because traders are weak, but because it misunderstands how the mind actually works. Willpower is a limited resource. It erodes under stress, fatigue, and emotional pressure. Trading places the mind in a constant state of uncertainty, where outcomes are unknown and feedback is immediate. In that environment, relying on willpower is like trying to hold back a tide with your hands. You may succeed briefly, but eventually the pressure breaks through. Structural simplicity removes the pressure entirely. True discipline emerges automatically when there is nothing to decide. When the trading process is simple, clear, and predefined, behavior becomes repeatable. The mind does not have to negotiate, interpret, or justify. It follows structure because the structure leaves no room for emotional debate. This is why professional traders do not rely on motivation or self-control, they rely on systems. Most traders sabotage themselves by making trading unnecessarily complex. They add indicators, conditions, confirmations, and exceptions. Each layer of complexity introduces another decision point. Each decision point is an opportunity for emotion to intervene. By the time the trade is live, the trader is already mentally exhausted from analysis, and exhaustion makes discipline impossible. Complexity feels safe because it creates the illusion of control. The trader believes that if they analyze enough, they can avoid loss. But complexity does not reduce uncertainty, it increases emotional attachment. The more effort invested in a trade idea, the harder it becomes to let it go. Losses then feel unfair, not because of money, but because of the time and energy invested. Structural simplicity works in the opposite direction. It accepts uncertainty up front and designs around it. The setup is clear, the risk is defined. The entry, management, and exit rules are fixed. The trader's job is not to think, it is to execute. This is not mechanical rigidity, it is psychological protection. When rules are simple and specific, the mind relaxes. There's no ambiguity to create doubt. Doubt is the enemy of discipline, because doubt invites interpretation, and interpretation invites emotion. A simple structure eliminates interpretation. The trade either meets the criteria or it doesn't. The action is either taken or it isn't. Discipline breaks down most often in moments of emotional intensity, after a loss, during a drawdown, or when an opportunity feels too good to miss. In those moments, willpower collapses, but structure holds. A trader who relies on structure does not ask how they feel. They do not ask whether this trade will make back losses or validate confidence. They check the criteria and act accordingly. This is why discipline should never be measured by how much effort it takes. If discipline feels hard, the structure is flawed. Effective structure makes discipline effortless. It aligns behavior with long-term goals without requiring constant self-correction. Another misconception is that discipline is about restriction. Traders feel that rules limit freedom, creativity, and potential profits. In reality, structure creates freedom. It frees the trader from emotional chaos. It frees mental energy. It frees attention to focus on process instead of outcomes. The only freedom that is lost is the freedom to self-sabotage. Structural simplicity also protects traders from their own success. Winning trades can be just as dangerous as losing ones. After a win, confidence can turn into overconfidence, leading to larger size, looser rules, and impulsive decisions. A simple structure prevents this drift. The same rules apply regardless of recent results. The trader does not become aggressive after wins or defensive after losses. Consistency is not achieved by making better decisions. It is achieved by making fewer decisions. Every decision requires judgment, and judgment is influenced by emotion. By reducing decisions, structure red. Usus emotional interference. This is the hidden power behind professional trading systems. Discipline also depends on alignment between belief and structure. If a trader believes that certainty is possible, they will resist simple systems because simple systems acknowledge uncertainty. They will constantly look for ways to improve, optimize, and adjust. This behavior appears productive but is actually avoidance of accepting randomness. Structural simplicity requires psychological acceptance of uncertainty. Once that acceptance is in place, simplicity feels natural. The trader no longer needs to outsmart the market. They no longer seek excitement or validation. They seek repeatability. The goal shifts from winning trades to executing trades correctly. This shift changes everything. A structurally simple approach also makes evaluation honest. When results are inconsistent, the trader can clearly see whether the issue is execution or expectancy. There are no excuses. There is no ambiguity. This clarity accelerates learning and growth. Many traders confuse activity with progress. They trade frequently, analyze constantly, and adjust endlessly, believing effort equals improvement. Structural simplicity reveals the opposite. Progress comes from refinement, not addition. Removing what is unnecessary strengthens what remains. Over time, structure becomes internalized. The trader no longer feels constrained by rules. The rules feel like common sense. Discipline is no longer something they try. To maintain it is simply how they operate. This is the mark of professionalism. The market does not reward intelligence, creativity, or effort. It rewards alignment with its probabilistic nature. Structural simplicity aligns behavior with that reality. It removes emotional friction and allows edges to play out over time. When discipline is built into structure, trading becomes calm. There is no constant inner dialogue, no second guessing, no emotional exhaustion. There's execution, review, and repetition. This calm is not passive, it is focused. Discipline is not about being stronger than your emotions. It is about designing a process that does not provoke them. When the structure is simple, emotions have nothing to attach to. They fade into the background where they belong. In the end, discipline is not a character trait. It is a consequence. It is the natural outcome of a trading environment that is simple, clear, and aligned with reality. When structure is right, discipline requires no effort. And when discipline requires no effort, consistency becomes inevitable. Profitability is never the result of force, intelligence, or emotional control. It emerges when the trader aligns with how the market actually works. When you stop trying to be right, accept risk completely, and operate within simple, well-defined structures, emotional conflict disappears. Discipline becomes natural. Execution becomes consistent. The market no longer feels threatening or personal. It becomes a neutral environment of opportunity. In that state, results are no longer chased. They are allowed to unfold. This is where trading shifts from struggle to professionalism, and where long-term profitability quietly takes root.